This Week in Economics on the 28th of October 2018, beaming from WBRN Radio and on the Bostonred Network. This is the Numbers Man section. We've been doing this program now roughly about 20 years. Anyway, nonetheless, we'll look at GMP. The advanced estimate is out from the people at the Bureau of Economic Analysis, and is normally the case. Our statistical part is supplied by Cranston Analytics, been our partner throughout our journey here, and it is quite a journey. We'll start out with some breaking news in the technology sector. As some people are aware, 10 years ago we started this program. It was more focused on the economics of information technology, and we quickly moved to macroeconomics, and basically it was a macro situation. Some would argue micro. The divisions between the two are a bit blurred these days, so we'll just keep blurring it along here. But nonetheless, a blockbuster deal announced by IBM, their purchase of the vendor Red Hat. And for those of us in the open source movement, this is, as Joe Biden would say, a big deal, no doubt. And I'm quoting here from a number of sources, Reuters, and this is the Business Insider. We were looking today, CNBC, basically, to acquire a Red Hat in a deal valued at $34 million. And what this revolves around and how it relates to our broadcast today is the stock market and its tech sector, where it's going. Nonetheless, let me just read a little bit of this. IBM is acquiring Red Hat in a deal valued at $34 billion. In a joint statement, IBM will pay cash to buy all shares of Red Hat at a premium price at $190. The open source, and that's where it blends into our broadcast enterprise maker, will become a unit of IBM's hybrid cloud division, with the Red Hat CEO joining the senior management team of IBM. J.P. Morgan advised on this and is leading the financial arm. The acquisition is by far the largest for IBM ever, the third biggest in the history of U.S. techs, excluding AOL Time Warner merger. The only large deals were a $67 billion merger between Dell and EMC. That was in 2016. And some other deals here: optical component supply, SDL. Well, that was in 2000, so I didn't really worry much about that one. Nonetheless, the chair Remedy told CNBC that the deal should not be interpreted as a part of any plan for her to transition out of her position as a CEO of IBM. I'm still young and I'm not going anywhere. That's what she told CNBC. But under her leadership, IBM has lost money. Open source has been the biggest theme in technology this year. Prior to IBM's purchase of Red Hat, two of the biggest tech deals were Microsoft's $7.5 billion purchase of GitHub, a code sharing service, and Salesforce $6.5 billion acquisition of MuleSoft, whose technology switches together different software applications, data, and devices here. So this is early this month, big data rival Cloudera and Hortonworks agreed to merge in a $5.2 billion deal. I wasn't aware that they done some work with both Hortonworks and particularly Cloudera. And what is happening here we won't get that much into it here. We'll do more of it on the open source report. But you're seeing more and more of these open source companies, tech companies, merging out there. So again, this is something that is happening, period. Agree that Microsoft's purchase of GitHub was irrelevant to IBM and Red Hat's decision to enter into this deal. That is from Remedi and Whitehurst. There, he's the CEO of Red Hat. Red Hat has been in talks for years about the potential of selling itself to other companies, including to Google. Now, that would have been a very interesting situation had Google actually bought Red Hat. Google would have made itself more open source. It would have been a very good move for Google. Never has anything seriously got off with it, people familiar with the matter. Now, we recall the situation when Red Hat, being in Linux, Red Hat is one of the distributions of the Linux software, is open source software that basically began it all. And IBM was the primary mover. $1 billion went into open source software, and that was to take on the proprietary shop of Microsoft. Apple was not much of a viable option at that time. They were around, yes, but there were no iPhones, etc. Thus, the whole argument in the open source movement was, how do we leverage this? In other words, how do we actually make money out of it? And Red Hat warped from a Linux distribution that happened to offer support to an enterprise Linux distribution that not only sold the software but also offered support. But lately it's been getting a little bit more tenuous with all of these cloud operations, whether they be Amazon, and this is where our report comes in. They moved into the macro level, where Amazon, Google, etc. The bottom line, as many in this country like to say, is that there's just not enough business out there for all of these cloud vendors. The cloud, when it came into existence, was a hype. Everyone was getting into the cloud business. Either they had some type of cloud, they'd purchase space in the data centers, or they were reselling or rebranding other cloud products. And you'll see more and more of this coming up. Let me just very touch on this. This is from Bloomberg, and this is cloud growth slowdown looms, suggesting tech boom near its peak. Now, this is where it comes in to the market here, and mentioned here is Western Digital. They're a maker of chips and hard drives. You don't see those anymore as much. A boom in spending by cloud service providers such as Amazon is showing signs of slowing. They have been buying stuff. Trade with China, monetary policy, foreign exchange fluctuations are causing concern the U.S. economy will slow and hurting orders for computer storage products. That's from Western Digital. So again, all of these different enterprises are themselves starting to suffer. Investors seem to be getting the message as Amazon fell as much as 10% on Friday. Alphabet 5.6%, and Western Digital plunged 22%. And the ISE Cloud Computing Index has declined 11 percentage points in October, outpacing the S&P. Excuse me. The S&P 500 at 7.8%. So these are some of the things that are going on here. Intel's data business, which provides chip servers and other silicon to the Googles, the Amazons, and other cloud companies, has grown 26% in the third quarter, passing sales of $6 billion for the first time. It racked up the numbers, even as general corporate spending on computer networks slowed. Now, China is the largest market and very important in the global supply chain. This is where the tariffs come in here. So we get a mixture of things here. Amazon, the biggest online retailer, on Thursday, reported second consecutive quarter of sales that fell short of estimates. The first back-to-back revenue miss in almost 4 years. The company gave a disappointing retail and profit forecast for the busy holiday season. This is the Santa Claus come down the chimney situation here. And high-profile cloud computing business Amazon service did not grow as fast as did in previous months. One of the things we're entering here, as we are in Q4 and going towards Q1 of 2019, the whole economic picture itself is coming back more to reality. If you recall, when we started in January, that would have been Q1, and we were working off of Q4 of 2017. What became very, very clear that we had what is usually termed in the media, not in the economic terms, of the Obama economy. That economy had moved along since the Depression and had added jobs, etc. And then came the tax cuts. The Trump economy, classic Keynesian type of economics came along. But with that, you also had an increase in government spending. Again, basically the same thing. But what was very unusual about it was the economy itself was improving. Normally, when you have an improving economy, you don't do those sorts of things because they throw everything out of line. That's been our theme the whole year. The basic tenets of macroeconomics were thrown out of line. Thus, the accommodative schedule itself has, and many of the conservatives had called for it the last few years to be discontinued. Now, the Fed is selling off some of those instruments that it had bought. And at the same time, interest rates are going up to combat the effects of tax cuts, rising employment numbers out there, and at the same time, salary compensation is going up, went about 1%. But and on the other end, inflation's also going up. So in other words, you have an interesting mixed bag of things that is happening here. And as we see more and more of the action moving from the central banks, and this is not only U.S. but globally, to these quote-unquote markets type of situations, and the markets become, not only in the U.S., but in the rest of the world, very, very important actors. So we're dealing with equities here, and also at the same time, the bond market, where the U.S. is there. Won't go into this. But this is a good time to move to a GDP from this, and what the effects of GDP will be. This is the gross domestic product. Third quarter, this is advanced estimate, and this will change, released on the 26th of October 2018 from the Bureau of Economic Analysis. Gross domestic product, GDP, increased at an annual rate of 3.5% in the third quarter, according to the advanced estimate released by the Bureau of Economic Analysis. In the second quarter, real GDP increased 4.2%. The Bureau emphasized that the third quarter advanced estimate released today is based upon source data that are incomplete and subject to further revision. The second estimate for the third quarter, based on more complete data sets, big data we'll call it, released on the 28th of November after the midterm elections. But nonetheless, the increase in real GDP in the third quarter reflects positive contributions from a personal consumption expenditure, what we call PEC, private industry investment, state and local government spending, to the prime federal government spending, non-residential fixed investment were partially offset by negative contributions from export residential fixed investments. Imports were subtracted from the calculation as it normally is. The deceleration in real GDP growth in Q3 reflects downturn in exports, deceleration in non-residential fixed investment, import increase in the Q3 after decreasing in the second. Current dollar GDP increased at 4.9%, or 247.1 billion in Q3, a level of 20.66 trillion. In the second quarter, current GDP increased at 7.6%, or 370.9 billion. The price index for gross domestic purchases increased at 1.7% in Q3, compared with an increase of 2.4% in Q2. The PCE index increased at 1.6%, compared with 2%, excluding, of course, food and energy. The PCE price index increased 1.6, compared with 1.2. Current dollar personal income increased at 180.4 billion in Q3, compared with an increase of 180.7 billion in Q2. Accelerations in rental income, wages, salaries, non-farm proprietors' income were offset by downturns in farm proprietors' income and slowdown in dividend income. Disposable personal income, something we watch very, very carefully here, increased at 155 billion, or 4.1% in Q3, compared with an increase of 168.9 billion, or 4.5% in Q2. Real disposable personal income increased at 2.5%, the same as in Q2. Personal savings at 99.6 in Q3, compared with, that's billion, compared with 1,054.3 billion in Q2. The personal savings rate, personal savings as a percentage of disposable personal income, was at 6.4% in Q3, compared with 6.8% in Q2. Now, these are just dates here. The advanced estimate will be on the 30th of January, 2019. And the second estimate, February of 28th of 2019. And the third estimate, to March 28th, 19, and so forth and so on. This is the schedule for next year, 2019. And let me just quickly move down here. We'll append this, incidentally, won't go over everything here. Let me just expand this a little bit here. Okay. If you look at a little historical here, gross domestic product, 2015 was 2.9, in 2016 1.6, 2017 2.2, and these are for various quarters. So we've been here before. We'll just go into, let's see, Q1 of 2015, 3.3%, Q2 3.3%, and then it's sort of just at 1 in Q3 of 2015, and just 0.2 in Q4. 2016 was a mixed bag. Q2 at 2.3%, and it would go to 2017, Q2 was at 3%. I'm just highlighting a little bit here. And we start to look at 18, Q1, 2.2%. And an outliner at 4.2%. That was in Q2 and 3.5% in quarter 3. Okay, this is government consumption, expenditures, and gross investment. Won't go as much into that. Where the feds were here, I think starting with 2015. We'd have to look up chart, but nonetheless, if we go into the, I believe the current quarter here, at 3.3. The federal government here was 3.3. National defense at 4.6. You can see where this is non-defense at 1.5. State and local at 3.2. These are government expenditures for the current quarter. And if we go back to 2015, was state and local were at 3%, non-defense at 3.1, and national defense at a negative 2. So a little bit of what is kind of going on here in terms of where. So in other words, you see the pump priming effect going on also. Current dollar measurements, GDP was at 4. This is in 2015. Now it's at 4.9. GDI at 3.7. This has been 2015. And that is up to 5 now. The average of GDP and GDI at 6.3 in 2015. It was at 3.8. Gross domestic product at 3.9. This is in 2015. Now that is gross domestic purchase. Now that is at 6.7. You kind of see how these figures have been going up in the last few years. Final sales to private domestic purchases. It was at 4.1. That would have been in Q1 of 2015, and now it's at 4.8. What we have here. Disposable personal income was at 4.4 in Q1 of 2015. And we now have disposable personal income, I should say, at 4.1. You can see it's less. It was 4.5 in the second quarter. I need to get to the top of my chart here. Make sure I'm giving you the right numbers. Okay. (2014) Q4. Following my chart here where we actually are. Q1 of 15. Actually, we got the Q3 would have been of 218. That is the last one. So let's go down here. I'll append this because it's a little bit harder to read our chart. Where we were dealing with personal income percentages here. Real gross domestic, I won't get into that one. Okay, that was actually 2015 in billions of dollars, was at 15 trillion 719.5. That was in 2015. In 2017, it went to 16 trillion, 830.9, and we quarter that out. In the third quarter, it was at 17,680.2. So you basically see where this is personal income compensation of workers, wages and salaries. A little different situation here. In 2015, it was at 7,854.4. And in the third quarter of 2018, it was at 8,905 point here. So, in other words, you can see where this is going. You did have some increase in terms of wages and salaries. And rental income, this is in billions, was at 651.8. That was in 2015. A little bit of contrast here at 767.5 in the third quarter. So you see it did go up some. Disposable income, this is one of the I thought we went over this, but it's one of the key areas that we look at. Disposable personal income was at 13,784.3, and our latest figure is at 15,613.1. That would have been in our present third quarter that we're giving here. And what else can we pull out here? Personal savings as a percentage of disposable income. It was at 7.6. And now we're at 6.7, just to make sure of it. Okay. 7.6, that would have been in 2015. It was 6.7 in 2016 and the same in 2017. Now we have a little less savings at 6.3 in Q3. 6.8 was in Q2. And Q7 was looking more like at 7.2. What the situation here is, there's just less savings. We'll put that on. And let me just... Amazon and their Santa Claus, the Christmas sales estimates slow down. This is going to affect Q4. Online giants that expected year-on-year sales to grow 10 to 20% for the 3 months ending on the 31st of December. This would mark a slowdown from the 29% jump in sales from the most recent quarter to 56.6 billion. Also, record profits at 2.9 billion in the period, compared with to 56 million last year. Oh yes, this marked the fourth consecutive quarter of more than 1 billion in profits for Amazon, and they had a 21% rise in operating expenses. Additional costs came from investment in Prime membership scheme. Offering home delivery for the Whole Foods operation. All of these food retailers are doing that, creating more original content. Well, that's something that you do. Now, this is back to our lead story here. The Amazon Web Services, that's our cloud service, increased 46% year over year to 6.75 billion for the quarter to the 30th of September. So you see the cloud element is becoming more and more of a part of Amazon. Other revenue categories that reflect the firm's advertising business jumped 122% to almost 2.5 billion. So if you start comparing that, quite a bit happening there in terms of their overall profit situation. And in the fourth quarter, they expect sales between 66.5 billion and 72.4 billion. On the call, they blamed somewhat modest holiday sales, and I'm not sure why. Forecasts on factors such as currency fluctuation is a global business. After ending 7% higher, shares fell 8% in after-hour trading in New York. The Amazon stock itself had jumped nearly 40%. So what had happened in last week, basically, the entire 2018 profits on Wall Street had literally been wiped away. So that is one of the big situations that is happening here, and we start to see it going more and more. Now, this is from Reuters. I think our last presentation was from the BBC. We're kind of skipping around a little bit. This is energy prices and the U.S. Suppliers. Worries over global petrol pricing. Oil line pipeline constraints are hovering over the energy sector as U.S. companies begin to report their quarterly. Third quarter profits from producers generally should be higher than a year ago because the average price per barrel is up 44% over the same period. But Friday's oil prices registered their third straight weekly decline, extending a slide on a concern that slower global economic growth. And, of course, the infamous U.S.-China trade war could dent demand. And U.S. crude is on track for a decline of roughly 8% for the month, while the S&P 500 energy index is down 12.2 so far, compared with a benchmark S&P 500 decline at 8.8%. U.S. crude prices had read roughly, $69.43 in the third quarter, up sharply from $48.20 1 year in the past. Analysts expect the boost of the S&P energy companies' quarterly earnings at 102.9%, the biggest expected year-over-year growth amongst the sector. This would be the biggest expected year-over-year percentage growth of any sector for the quarter. Some investors say it may not be enough to reverse the trend in shares given other worries. Now, one of the things always to watch, it's sort of like a baseball game. We had one the other night. I had several of them in the League Championship Series and, of course, our World Series, where one team was pounded and come back the next night. You have a 2-1 game is what happened with the Dodgers when they were finally able to win a game. Not last night, another plummeting. But this is sort of akin to what is going on here. From Cherry Lane Investment, something in New Vernon, New Jersey. I expect earnings will be good because the quarter prices were good. Well, that is interesting. Companies that provide drilling and other work, we usually go visit our friends at Baker, which is now part of GE. Have blamed a near-term slowdown in service demand due to pipelines and other constraints, particularly in the shale field of West Texas. Upcoming earnings reports from ExxonMobil, Chevron, both due. That'll be on the 2nd of November. Exxon is down 9% for the month to date, and Chevron is down also 9%. So all these companies are down. Another producer, Hess Corporation, is due to report on Wednesday. ConocoPhillips, that's the world's largest independent oil gas producer, beat the estimates for profits in Q3 when it reported Thursday, citing higher oil prices and also cut in costs. So you can see a lot of cutting in costs around. People are still thinking we're at $40 a barrel. We're not. that is at Cobalt Wealth Management in Salem, Mass., which owns a shale producer, Diamondback Energy. People are misjudging the balance between supply and demand. This is from Lutz. Seeing oil prices heading towards $80 to $90 a barrel within a year. And, of course, it settled the U.S. crude at less than $70 a barrel. So you're talking about anywhere from a $10 to $20 increase. I would take on that, given current economic conditions and economic conditions going in to 2019, this will not happen. On a global sense, the world just cannot afford these oil prices. Now, could you have an aberration? Yes. But it would be a spike, and the spike would soon diminish. Now, another wrinkle here, energy shares, people are fleeing, and this happens in the market. They flee one sector, the high-flying tech stocks are not flying so high. And this is one of the situations here you have, and this happens particularly with U.S. companies. For instance, Amazon, Google, Facebook, and a lot. The problem there is it's akin to what happens in commodities. Much of it is hype. And when you have Amazon, the new buzzword, it's sort of like the buzzword cloud computing, is now coming down from the cloud, so to speak, pardon the pun. And we're getting to more of a normalized relationship. Are we getting to a mature market in terms of clouds and related products? Yes and no. And this is one of the big problems that when you have hyper advertising of certain sectors, and then the reality sets in. And as you have more of a global, you look to China, downturn caused by a number of things, including the tariff regime that's not going away. And, of course, it sets in here in the U.S. And also at the same time, consumers and where this consumer sentiment is not as high as it was, and how consumers plan to pay for the ride on Santa Claus sled. Are they paying cash? Or are they using credit cards or whatever? And Walmart and some of those retailers have started retailing in October. And the long season, if you start in October, by the time you get to the normal Turkey Day situation, people have purchased most of what they want for their holiday list or for whatever. And thus you do some cutting, but how much cutting will they do? How much traffic will they get? And this is why Amazon has said they will get less traffic. And of course, being a global business, it's now settling down to a more mature market. So these are some of the things that are affecting them directly. Here, let me just go to, where do we want to go? This is from Bloomberg here, but stock market strains have sent message to the Fed they don't want to hear. This is a little article here. The Fed's fermented stress are everywhere, from slumping bank stocks to 33% plunge in home builders. They are in the market's newfound willingness to differentiate between defensive and cyclical stocks. A bias, absent from past meltdowns. They're in giant yields, greeting stellar earnings. The evidence investors have something else on their mind. The fundamentals are strong. Goes of the reframe the economy can absorb some tightening, but with 8 rate hikes in the book already and more to come, it's obviously many investors are feeling otherwise. The sell-offs show that the market pricing are in a slow growth and more a risk. That is from someone at Welcher Beth Capital. The Fed may not necessarily see that. Whether or not they do, as the policymakers, they don't mind it. The ups and downs of volatility, is typical of stocks. To know about that. That is from Robert Kaplan. He's president of the Fed Bank in Dallas. A day earlier, the Fed chief in Cleveland, investor, said we are far from the turbulence that would lead to a big pullback in spending. The volatility ramped here. I don't see they are nervous. That's a Robert Purley, as a partner in Cornerstone Macro Inc. in Washington, and a former Fed economist. None of that helps if you watch a $10 trillion dollar loop from U.S. equities prices in a month, even as bonds and currency remain calm, while the stocks are clearly on their own animal. All hair-triggered volatility and floated valuations. The straightforward evidence that tighter conditions are at the center of the tempest is in the rate-sensitive growth stocks like home builders and banks. Building companies have tumbled in 9 of the past 10 months. That's to be expected. Banks normally benefit from higher rates, have slumped 15% on concerns of rising financial costs, have tripled loans. Well, the February sell-off crashed everything. This time defensive sectors are holding up. It's a sign to some investors that adjusting their stance on past expansions. The rotation was displayed on Wednesday when consumer discretionary firms, the top gainers of the bull market, trailed the consumer staples by the most since 2009, Depression days. Utilities, one of the best crowded groups in the S&P, outperformed industrials by the most since the Depression. This trend is here to stay. For the week, consumer discretions slid 1.4%, pushing the S&P 500 towards a 3.9% slump. The Dow fell 3%. The volatility index rose to 24.40 after closing above 25 on Wednesday, the first time since the February rout. A more abstract concern relative to the reception corporate rate received this season. In short, there wasn't one. Companies that beat the estimate didn't rise. Companies that didn't fell only modestly. Corrections which usually loom as corporate results cause individual stocks to chart their own course. Never unwound. In fact, got tighter and the month progressed. One interpretation of this is that the stock market is correctly anticipating weakness in earnings and in the economic growth going forward. That is from Ethan Harris, head of global economics at the Bank of America. When the Fed goes into a tightening cycle, which we have been in for the past 2 years, consistent movement investors don't expect this to be painless. No doubt, the Bank of America thinks the S&P needs to fall to 2,500 or lower to alter its pace. That means that stock prices on so-called power put would require further downside at 6%. So the market is changing. While signs abound and investors are paying a price for the Fed's hawkishness, other parts of the market are saying the hawkishness is misplaced. Index compiled by Citigroup stalked by whether they will do well or do bad when inflation rises. Right now, the one that do well are plunging, and arguably a sign the market doesn't think there's much inflation to fight. Volatility in major developed nations' currencies well below its high for the year. J.P. Morgan Chase's gauge in a government bond market 10-year treasuries yield has just been their biggest in their biggest weekly decline in 2 years, an indication that plots expectation for price pressure in that market via rates on inflation-protected bonds is starting to show that the Fed's policy is becoming too tight. Doubtless. Government reports don't show the economy overheating. Existing home sales fell to their lowest since 2015. That's lots to do with supply and other things. That doesn't signal a recession is looming. That's according to Neil's data. Renaissance Micro Research ahead. Remember, weak data signs that the pace of further rate hikes should be consistent with economic conditions. No doubt it is. They have weaned the market off of forward guidance, which implicitly means that the data is going to drive the boat. So let's focus on the data. I don't think inflation is going to come back to like 1% or something like that year over year, but it's going to accelerate. I'm skeptical of that, and remember what the Fed has in its forecast. Well, inflation is out there. There's no doubt about that, and obviously something had to be done there. Let's do commodities quickly here. The Bloomberg Commodity Index at 0.78. That is the change in it at 176.20. The USB Bloomberg is at A plus 2.8. That is a change in it. The Reuters a change at 0.075. The Reuters International at 13.28. And the S&P, the change there is 17.71. We've already given the price, West Texas crude at $67.59. T-Boone picking a jumping for joy there. Brent crude at $77.62. The natural gas down 2 cents there with it. Gold at $1,235.80. That change is $3.40. On the spot, $1,233.53. It gained $1.38. Silver was up 7 cents at, where's silver? $14.07. Platinum was up $5.21. No pork bellies for us here. Corn was up $18. Cocoa was up $42. That was the Bloomberg part of it. And let's get over to the BBC here. And we'll get to basic markets here. The FTSE was down 0.92%. In Amsterdam, they were down also 1.10. In France, they were down 1.29. The DAC was down 0.94 in Germany. The Eurostrasse down 0.39, all the negative there. In Spain, they were down 0.62. The Dow was down 1.19. The Nasdaq down 2.07. And in Chicago, the S&P 500 was down 1.73. In Bombay, they were down 1.01. These are on Friday, unless otherwise noted. Hang Seng in Hong Kong down 1.11. The Nikkei was down 0.40% there. We've already given the various crude oil in the West Texas situation there. The Forex, I don't know if we got the Forex the last time. It was up $3.90. This is gold, $1,236.05. And the fix, there was no change there at all. This was the BBC part of the story. Let's just make sure we got everything here. Paul Volcker recalls another time the Fed chair clashed with the president. Repeated Trump's criticism of the Fed's monetary policy seems extraordinary, but it isn't the first president to oppose raising rates. This is according to Paul Volcker. He's 91 years old. Was with LBJ, and as the Fed chair, he was incidentally, Paul Volcker was the Fed chair during the Reagan administration. There, he was appointed by Jimmy Carter. The quest for sound money and a good government, written by the editor of Bloomberg Market, Christina Harper. Volcker was the chairman from 1979 on Jimmy Carter to 1987. Almost the end of Reagan's administration. Very long time there. This dates back even to old William McChesney Martin. Remember him? He was the Fed chair in 1965. So there's been a difference of opinion there. And going forward on it with Paul Volcker, I later surmised that the library location had been chosen because, unlike the Oval Office, it probably lacked a taping system, the meeting going on recorded. I repeat incidents to other members of the Fed. And William Proxmire was still around in those days. And I'm not sure. Continental Illinois. I was working at a bank in Chicago at that time. Anyway, was stunned there. What happened with the Continental? That was when Jim Baker was around. He was chief of staff on the Reagan. A challenge only once in my direct experience in the summer of 1984. I was summoned to the White House for a meeting with President Reagan. It didn't take place in the Oval Office, but in the informal library. As I arrived, the president is sitting there with Jim Baker. Seemed a bit uncomfortable. He didn't say a word. Instead, Baker delivered the message. The president is ordering you not to raise interest rates before the election. I was stunned. This is Paul Volcker speaking here. I wasn't planning the tightened monetary policy at the time in the aftermath of the collapse of continental Illinois. Market interest rates had risen. I thought the might need to calm the market by easing it a bit. And he was fighting inflation, which was up 19%, 15, 16%. Of course, that was good for people that held CDs. This is the failure of Continental Illinois Bank in 1984. That was the largest in U.S. history at the time, giving birth to too big to fail. Nonetheless, let's check our time here. We're finishing up our report, running a little bit over, but not too badly. Nonetheless, we start out with GDP, and we'll finish up with GDP and respectable, but I wouldn't put a lot into this. At 3.5%, we'll have to look at the next installment of this. This is the advanced estimate. It will change when they get more complete data out there. Let's see. The second estimate, that'll be in November. So we'll see how that plays in. And where the tech companies are a very important part of the market, they are coming down, as they say, to more ground level. We'll start to see results. Where will the Santa Claus situation play in? The National Retail Federation has forecast a rosy condition. Will those rosy conditions materialize? Will consumers come in mass for one more big one, as they say? Or will they hold back? And of course, then we go into a Q1 when people start to get their returns back after the April 15th deadline. Actually, people now get their returns back that filed last week in January. Will that be an influx of money? But remember, the tax cuts have already been there. People are seeing those in their paychecks. Are really not seeing them because you don't get the W-2s anymore, whatever it is. But at the same time, what realizations are they getting from their 401ks? Those will be down. And how the tariffs will affect them. Prices have went up at the Walmarts of the world, every place else. So what happens is the Walmart cut prices on their loss leaders or whatever they're doing. They are trying to pull traffic into their brick and mortar or online situations. All the retailers have upped their online game. Would it be Amazon, it'll be a retailer like Best Buy, etc. And at the same time, Sears is starting to liquidate inventory in some of their stores, not very fast. But they are closing stores. Who will benefit, who will not. With sort of the line out there in terms of the retail sector, there's just not enough retail growth out there to accommodate everyone. So yes, there may be some temporary gains for some of the retailers when Sears goes out. I think it was at Best Buy that figured their appliance part would gain some. But you also look at home builders. That used to be the big thing for refrigerators and so-called doable goods, where they will go. So those are some of the mixed things we are looking at here. For those in business, make next week a productive one. The consumer, your eyes already on the prize. And we'll see you next week.